to you all, depending on where you're joining us from. We're delighted to have you here today for our 5th webinar on the topic of Pillar 2 and the associated technical, technological and practical considerations. Today's webinar will cover practical matters relating to establishing an effective Pillar 2 process for your group, some of the technical challenges in application of the transitional country-by-country safe harbour, which I'll abbreviate to TCSH from now on, how to approach the data challenge, and some thoughts on governance as we head into the first reporting period for which Pillar 2 has been enacted. So a couple of admin points before we begin. Due to the number of people on the call today, your mics are all muted. However, we would, of course, love for you to interact with us throughout the session. With that in mind, there'll be an initial polling question shortly, and you're also welcome to place questions in the Q&A box throughout the session. We'll try to respond to questions in the webinar, or otherwise we'll collate and pick up questions at the end. We're, of course, also available to follow up discussions after the webinar to address your specific circumstances in more detail, so please feel free to contact the speakers today or get in touch with your usual video contact. We will be sharing the slides and recording with you all after the event as usual. And by way of a brief reminder, to date we've covered an overview of the technical aspects of the Pillar 2 rules, some jurisdictional nuances, technology considerations, compliance considerations, and all of those recordings are also available to view through the links provided at the back of this slide pack that will be circulated. So without further ado, let's launch our polling question, please. So hopefully you'll see it now. We're really interested to understand which of the many challenges of Pillar 2 are your key areas of focus as we head into 2025 reporting and the first period of application of the Pillar 2 rules come to a close for many. So if you could just provide a single choice answer to the poll, just give you a minute or so to do that. And whilst you do that, I'll just carry on maybe with a framing of my perspective of where we're at on Pillar 2. So in overview, we've got 37 territories now that have implemented Pillar 2 rules in whole or in part, and there's a further 27 in various stages of consultation of draft legislation. So it is truly a global challenge. Many of those territories began with implementation of IIR and QDMTTs with effect from 1st of January 2024, and we're now approaching the close of the first period for many where there could be some top-up tax to pay. We've seen accelerated registration deadlines and even prepayment requirements on top-up taxes in some territories, notably Belgium, with obligations in Hungary and Germany also fast approaching. Monitoring and managing these different timelines will remain a challenge through 2025. As we approach 2025, UTPR will come into effect in a number of territories, which will significantly widen the application of Pillar 2 for groups which are headquartered in jurisdictions that have not yet implemented the income inclusion rule, notably the US and China. The additional complexity that the implementation of UTPR may bring should not be underestimated. And if that is relevant to your group, I would encourage you to look at that as soon as possible. The interaction with the application of the TCSH, the Transitional Country-by-Country Safe Harbour, as I said earlier, will be critical, and we'll touch on that again later. We've seen further guidance from the OECD in 2024, and the fluid nature of the rules and their interpretation remains a key challenge. And this is further compounded by the lag in implementation of OECD guidance into local legislation. We now have significant practical experience of some of the challenges arising on application of the rules, and we'll try to draw some of those out today, with a focus really today on matters relating to the application of the TCSH in that regard. But despite all of that complexity, Pillar 2 is a tameable beast through a methodical, well-planned process. And that's where we're going to start today shortly on how we approach the overall Pillar 2 process before we then move on to how to ensure effective application of the TCSH, to simplify that process, how to tackle the data challenge, how to build governance to give stakeholders both internal and external confidence in the overall outcome. So before we do that, I'll maybe just summarize the outcome of the poll. So it's a relatively even split, with 37% saying they're really focused on compliance and reporting requirements. The next then is getting finance and tax teams up to speed with the legislation at 26%. Concentrating on incorporating Pillar 2 into existing processing controls is 21%, and then 15% focused on how technology can help me navigate the huge data challenge. So a good split. I'm pleased to say we'll be covering all of those topics, so there should be something for everyone. But without further ado, Scott, over to you in relation to Pillar 2 process overview, please.
Thanks, Ross. Teaming with you across the pond has been a pleasure, not just because you share my twin brother's name. So my name's Scott Klein, and I'm an international tax principal with our U.S. practice. I'm delighted to spend a few minutes with you to discuss our Pillar 2 process framework. I'll try to cover as much ground as possible to provide an overview of a start-to-finish Pillar 2 process, realizing that task is not a possible one in 15 minutes. We can go to the next slide, please. While many of the Pillar 2 calculations involve basic addition and subtraction, the substantial quantity and quality of data and calculations required makes them significantly time-consuming and causes risk for missing amounts in the additions and subtractions. So a process to mitigate this risk becomes indispensable to manage and potentially eliminate a Pillar 2 tax and/or a control deficiency. With this in mind, we've designed our Pillar 2 calculation engine based on process. If you've heard the expression garbage in results in garbage out, we chose to focus on minimizing the garbage in to best prepare for eliminating the garbage out. Much of the complexity from gathering the required data stems from a company's own processes and data limitations that we need to be cognizant of. We provide Pillar 2 data lab sessions with our clients to adapt to and incorporate a company's natural processes, adjusting only those as needed to obtain required data to prepare the calculations accurately. This improves the likelihood that the process will be sustainable and repeatable. With that, let's turn to the process framework. Next slide, please. As overwhelming as this slide is, it would be too overwhelming to prepare Pillar 2 calculations without an organized and comprehensive process in place. Again, due to the quantity and types of data and number of calculations that are required. Divided into 3 phases on this slide, none of the 18 items on the left of the screen are optional. Even the item 17 that references elections. In other words, we have to make sure that the company's process includes the data collection and technical analysis for all of these items. Beginning with item 1, which we'll talk about a little bit more on the next slide, globe calculation setup phase. Each of the constituent entities that are part of a multinational group and the period in which they are part of the group must be identified in order to determine which entities are included and to what extent their financial results are included in the company's Pillar 2 calculations for the period being analyzed. Item 2 involves classifying entities under the Globe Entity Classification Rules. Those complying with the Belgium registration requirements a couple months ago will be familiar with some of these classifications. An entity's Globe classification as a JV, a tax transparent stateless entity, a reverse hybrid stateless entity, a hybrid entity, one of the 4 types of permanent establishments, an excluded entity, and there are multiple types of them, will dictate whether, how, when, and in which jurisdiction to include the entity's income and taxes to calculate a given jurisdiction's effective tax rate for the Globe calculations. Moving to the second phase of the Pillar 2 process framework, item 3 is the first of 2 Globe information checklists. This one for the transitional CBCR safe harbor. Our checklists request information in a simple confirm or deny format with the intention of parsing through and casting aside data and adjustments that are not relevant for your given company. For example, if your group does not have an insurance company, then let's not ask you for the 8 pieces of data and calculations that are relevant to insurance companies. The same with qualified shipping activities. or additional tier one capital for a banking institution. So the quicker that can be done, we can turn our focus to the items that are relevant to your company. These checklists are an auditor's favorite and support a company's internal control process. Item 4 involves qualified financial statements. This was a new requirement. Well, it wasn't a new requirement in the December administrative guidance, but it was new that they used the words disqualified several times. And so if you don't have qualified financial statements for a particular jurisdiction, then you'll be disqualified from applying the transitional CBCR safe harbor for that jurisdiction. We'll talk through that item. We're going to click on a couple of these and go into some. This is all part of our step-by-step guide. Item 5 involves classifying the company's income tax, eligible payroll, eligible tangible assets, income, and other data required for the transitional CBCR adjustments to prepare the 3 tests under the transitional CBCR safe harbor. After having all the data accurate and in order, the actual processing of that data can occur, which happens in item 6, calculating the transitional CBCR safe harbor tests. By doing items 1 through 5 thoroughly, the calculation outputs in item 6 will not be comprised of garbage out. The third phase, starting with item 7 for the detailed GloBTR calculations, involves process, which in practice comes into play for jurisdictions that don't qualify for a transitional CBCR safe harbor. Certain companies that we're working with have chosen to undertake the phase 3 work for all of their jurisdictions in anticipation of potentially not passing a transitional CBCR safe harbor. For example, if a company's financial statement auditors are requiring a release of a valuation allowance that drives the company's GAAP ETR below 15%, and the company's in a rush to file its financial statements, but has never analyzed any of the adjustments that are required in these black cells, then they just don't want to be caught in that situation. So our calculation contains a step-by-step guide to go through each of these items and incorporates the process into the calculation engine that prepares the Pillar 2 calculations and applies the QDMTT and charging provisions. Let's turn to the next slide, please, for a couple examples. So we just picked items 1 and 4. There are 21 items, but our step-by-step guide has each of them. And what we wanted to do was have a process checklist where you check the item, a responsible party, and a date, and it goes through each of the things that are required to prepare the calculation. So I won't walk through this in detail, and the slides will be sent out to all who registered. But you could see on this one, for example, we've got 3 steps that form the basis for item 1. We have defined our UPE, each of our constituent entities and our separate JVs and JV subsidiaries, the period in which their financial results are part of the data for the calculations, and item 1 is finished. So only 17 left. So we also have in our step-by-step guide, and this is in our calculation engine. So the battery life corresponds and reports into the dashboard. So it's a process and an engine. And in this illustrative example, this company's 52% complete with an overall process for all the required items, but we're done with item 1. Can move on to the next slide, please. Item 4. So qualified financial statements. From the December administrative guidance, a lot of additional process was required because now we have adjustments that have to be taken into account in order to have qualified financial statements. We have a new consistency requirement. So any data that we are using on an entity by entity basis needs to meet the consistency threshold. A no adjustments rule that we'll talk about in a little bit, but this has become very popular for financial statement auditors. All of the financial statement auditors for my clients want to see a detailed process to support how do you have QFS if you're applying a transitional CBCR safe harbor. So we go through in this one 7 steps. And so for the first step, you can see each entity has to pick which qualified financial statement type it's using. It's not optional. So for each of your entities, and then after that's done, we check it off. Step 2, we have some reprieve for permanent establishments in the December administrative guidance that we don't have to use a qualified financial statement, but they do provide a specific set of sources for where we can obtain what I refer to as our big 5 data points, which are in step 3. This is the safe harbor data set where we have to comply with the consistency requirements. So each of these big 5 data points has a defined term. I don't go into it here. It's all in our step-by-step guide. But each of these data points has to be sourced from the qualified financial statements. Go to the next slide, please, Natalie. So step 4 here, along our process as well, we've developed various tools to help with each of these items, and some multiple tools in a given item. So on the next page, which don't go to yet, but what we'll do is we'll show an executive summary of the qualified financial statement testing template that we've developed to help our clients. So what we're trying to do here is to support that the data that we've used in step 3 is actually qualified financial statement data. So you've got consistency requirement that has to be followed, a no adjustment rule. They've got now rules on purchase price accounting adjustments. So we go through each of those and we have to check them off because they're required. They're not optional. After we're done and we can prove out that our data is from qualified financial statements, then we go back and we'll update the data in step 3. And that's the data we'll use for our transitional CBCR safe harbor. If we go to the next slide, please. So here's a look at one of our tools. This is our qualified financial statement testing template, just the executive summary. And so we have 4 different tests to support that we are using qualified financial statements for a jurisdiction. Test 1, we're reconciling the qualified financial statements to the consolidated financial statements. And so for each of our data points that are part of our safe harbor data set, that has to be done. Test 2, to the extent that our qualified financial statements are not just derived from a single document, for example, a consolidating trial balance, which happens very often because a number of our clients, they use an income tax provision software to support their income tax expense amounts, and then they don't put those income tax expense amounts back into their consolidating trial balance. So now we have 2 documents that are forming the base of our qualified financial statements. So we have to make sure that on an entity by entity basis, those documents are consistent. So we do that for the tax provision through profit before tax. So if we can show that in our tax provision for each entity, it's using profit before tax, that ties to that entity's profit before tax from its consolidating trial balance, then we have consistency. And so many companies have additional adjustments and documents they do as well. So we have a process to support each of those documents as consistent. The third test comes a bit later. It's then making sure that our CBC report has qualified financial statement data. And then lastly, we have testing of qualified financial statements for accuracy. So we have about 7 or 8 analytics to show that, for example, do you have an entity in your consolidating trial balance plus your tax provision that has $500 million of income and 0 taxes? How could that be? Maybe it's an Australian entity that's part of the MEC group and its taxes are being picked up at another Australian entity. That's fine. And every time we go through this exercise, we have a number of different entities that pop out, but then we have support for why that is permissible. We can go to the next slide, please. So here is an example of test 1. And again, the executive summary was on the prior slide, but you could see we have a difference between our consolidated financial statement revenue and our qualified financial statement revenue. And this is supposed to be. Our qualified financial statements are pre-elimination. So for this example, this group has $4 billion of related party revenue. That's okay. It's a permissible difference, but you need to show a reconciliation of it because not all these items tie. Another example would be interest. In the consolidated financial statements, you could report interest as an item not part of your operating P&L. whereas that has to be treated as revenue for qualified financial statement purposes. So we show how all of them tie out, and it comes up in from an entity by entity basis, which is on the qualified financial statement tab down below. So this, again, just an example. There's a number of different tools and things that we have as part of our process and that we would incorporate into yours. We go to the last slide, please. Okay, so last component for item 4, step 6 and 7. And so here, these items are they're not going to be complete yet, but the idea behind having a process is let's not lose track of them. This is why we're only 5 out of 7 or 71% finished with item 4. Here it's the CBC report. The reason why CBC reports, they're not prepared yet for 2024. It'll be done in 2025. And it'll be done probably toward the middle of the year in 2025. And so we want to make sure that, because there are certain rules that are required in order to have the qualified CBC report, that these additional 5 data points come from one of the required sources that are in the rules and which are stated on this page. Lastly, in step 7, there's a no adjustments requirement or else we'll face being disqualified. And so what this says is your CBC report for certain of your data points cannot in any way deviate from your qualified financial statement data. And so if it would deviate, even if it's to improve the accuracy, the rules say, then you could be disqualified as well. So what this means, and in the last checkbox, is we'll expect to have a lot of return to provision adjustments because you can't adjust what was on your provision. And so with these return provision adjustments, it's simple, again, for a financial statement auditor to check because they're always looking at your RTPs. Let me compare that set of RTPs with the RTPs you have for your safe harbor process, and I'll be able to see if you have qualified financial statements in that regard too. So there's so much more to cover, and we just had a limited amount of time. But I wanted to provide some color on the importance of having a process and being methodical about it. With that, Frederick and Hedel, I turn to you for a deeper dive on some safe harbors.
Thank you very much, Scott. Next slide, please. So, as part of a rigorous and solid framework to approach Pillar 2 as a group, you need to also be able to have a framework for your safe harbors. Performing full globe calculations for all the jurisdictions where your group is present, that requires a sizable time investment in processes, in a framework, some legal analysis, tax accounting analysis, getting your data right. But fortunately, for the earlier years of Pillar 2, there are various forms of relief in the first years where you may benefit from. A principal source of relief will be the transitional CBCR safe harbors, which, to repeat, and you will be familiar with this, consist of 3 separate tests. There's a de minimis test, which may be met in jurisdictions where your group has relatively little presence. There's a CBCR test, an ETR test, effective tax rate test, which may typically be met in higher tax jurisdictions where your group is based. And there's a routine profits test, which in any event will be met when you have entities and jurisdictions that are loss-making. One of the 3, meeting one of these 3 tests, means you'll satisfy the safe harbors. So what are the benefits of these 3 transitional CBCR safe harbors? A very clear benefit is that some key elements composed therein, such as profit before tax or income tax expense, can be taken directly from the CBCR report or from your financial statements and require only little adjustment. Another point is that the calculations under these safe harbors are far simpler than the full calculations and all the potential adjustments you may need to make under the full globe calculations. And lastly, with the risk of stating the obvious, no top-up tax is due for a certain jurisdiction if one of the 3 tests is met for that jurisdiction. So it's a really simple way to find out if top-up tax is due for a jurisdiction or not. But be aware, once out means always out in the context of these calculations. And that means if you do not satisfy the CBCR safe harbors in a year, you may not rely on it for 1 or 2 of the other next years. In addition to the CBCR safe harbor, there are 2 other important forms of relief. One is the QDMTT safe harbor, which means you can avoid making duplicate calculations by focusing only on the QDMTT applicable in the local states and not having to do a separate form of IIR calculation in the state of your UPE. So it's a simplification, but you still need to make a calculation. Another form that is another rule that offers significant relief is the UTPR safe harbor, which is principally aimed for those countries, and most will implement a UTPR as of 2025, excluding the application of the UTPR in 2 years of election, when the UPE is resident in a certain state that has, let's put it like this, an ordinary income tax rate. Principally, of course, this is aimed at companies with a UPE in China and the United States. They will be the main domain of this UTPR safe harbor. But do note, it does not prevent an applicable UTPR from potentially catching up and picking up profits elsewhere in the group that are not related to the UPE and its state of residence itself. We can move to the next slide. I'd like to focus a bit more on the requirements for applying the transitional CBCR safe harbor. And one important requirement is that we're working with a qualifying CBCR, which means that the data in your calculations is derived from qualified financial statements. The qualified financial statements, in short, are the account that you use to prepare the consolidated financial statements for your UPE, the GAAP that you would have for that UPE, or the local GAAP accounts that you might use to file for the local entity accounts you'd have locally. So there is a free choice between the consolidated accounts and the local GAAP accounts. But in ensuring and in reviewing whether you have a qualifying CBCR, you need to consider the guidance that is in the various documents released by the OECD, very lengthy documents, and in the commentary. And in some cases, this means that the accounts you're using require mandatory adjustments in order for them to satisfy the requirements of the CBCR safe harbor. A couple of points when we are performing a review of the financial statements and want to assess whether they are qualifying. Typically, there are four or five areas that we would typically examine. One is whether the financial accounts that are chosen to represent the QFS tie out the consolidated financial statements on a constituent entity basis. This is again to understand that process where you're relying on consolidated financial statements as basis for your CBCR. Can you break it down all the way to constituent entity accounts, and is that fully reconcilable? Then there's the requirement of consistency. All data sets used for a safe harbor calculation must come from the same qualified financial statements, at least for a jurisdiction. That means that there is the question of, are the financial accounts that are used to compute, for instance, the profit before tax, the same that are used to compute the income tax expense that is based on that particular profit before tax? In other words, it's a question of, is the data used consistently? A third question is, can the QFS be fully reconciled with the CBCR data without any adjustment, at least without any of the mandatory adjustments that must be made? And fourthly, it's a question of, are the QFS accurate? And that will be particularly a relevant question when financial accounts rather than audited financial statements are used. And the question is then, are they accurate in the sense of that the numbers are correct and that they are based on the correct GAAP, the correct accounting principles? Hetal, moving over to you.
Thank you, Frederick. So I will be discussing the key points that groups need to consider when applying a CBC safe harbor in any particular jurisdiction, with a focus on producing a qualifying CBC report, as this is the area that we're finding most groups are struggling with. But it is a critical element to claiming a CBC safe harbor, as my colleague Scott has just alluded to, is going to be something that the tax auditors are going to require as well. I will also share our views on what tax authorities will expect from businesses, and this is based on our interaction with UK tax authorities, where we have reached out to seek clarification. So sorry, next slide, please. We're still on the... So you can see on this slide that a qualifying CBC process is more than just using data from QFS. QFS is just the starting point, and as my colleagues, both Scott and Frederick, have mentioned, they've gone into the details of what constitutes a QFS. So the one point I'll mention here on QFS is that it is jurisdictional in the sense that you can use different QFS for different jurisdictions, so long as there is consistency in the QFS being used for entities within a jurisdiction. You then move on to the CBC, whether the CBC report is prepared in line with the local legislation. And what does that mean? So from our interactions with HMRC, the CBC should be looked at in the whole, and it should not just focus on the data points that are relevant for safe harbor computations, such as the PBT and revenue. So there is a need for accuracy across the report, which is a much stricter test than we had initially anticipated. The next step in this process is to consider the OECD guidance on safe harbors. And we had discussed this in our previous webinar in May, but I will touch on the ones that we have had subsequent clarification from UK tax authorities and the ones that come up quite regularly. So the first one is the manual adjustments. Scott has mentioned that, as I mentioned earlier, that manual adjustments are not allowed to be made to a CBC report unless it's explicitly required. And we've come across various businesses that do make these adjustments in CBC report for perfectly valid reasons to enable accurate reporting or to reconcile their data to another external report. But there is a risk that this could result in the report not being qualifying. However, upon clarification from HMRC, our understanding is that if the adjustments made to the data is in accordance with GAAP or to produce a CBC report in line with the relevant legislation, then those adjustments may be considered acceptable. And whilst this provides an element of relief, we would recommend that any adjustments being made are reviewed in detail, and there is documentation to support the audit process, as well as this will be requested by auditors. Another area that I did want to talk about was sub-consolidations and divisional reporting. So sub-consolidations is very common where groups will consolidate at lower levels, and then it is the sub-consolidated data that feeds into the CBC report. Divisional reporting is also very common where groups will be using divisional accounting. So effectively, the data is not coming from entity accounts to prepare a CBC report. In both these scenarios, there are two risks. First, that the source that is being used is not, strictly speaking, a QFS. And secondly, that manual adjustments are being made to the data to feed into the CBC report. Based on our interactions with the UK tax authorities, our expectation is that authorities are likely to take a pragmatic approach to the data reported within the CBC if it is the same as it would have been had it been derived directly from a QFS source. Another area that we find common errors in is the entity classification, and in particular, classification of flow-through entities. So there are special rules for such entities under Globe rules, and the rules in the safe harbor, for safe harbor purposes, are trying to mirror these rules as well. Flow-through entities are stateless entities and cannot apply safe harbors. And if the flow-through entity is in a UPE jurisdiction, which is very common amongst professional partnership structures, all entities within a UPE jurisdiction cannot apply a safe harbor unless specific conditions are met. Another implication of incorrect classification of a state as an entity is that its income will not be attributed correctly to the right jurisdiction. And there is a risk that the stateless jurisdiction will not be able to apply a CBC safe harbor, and neither will be the jurisdiction where the income should have been reported. Therefore, you can see that entity classification is critical. There are lots of other common areas. Some of these are listed in the boxes here, but there are plenty outside of this. However, due to time restrictions, we won't be talking through all of them. So I'll move on to the final element of this process, which is making the actual adjustments for safe harbor computations once you've done a CBC process review. The most complex one out of all of this is the arbitrage arrangements, and then there is a PPA adjustments as well. The net unrealized fair value losses is fairly straightforward in that what it says is if there are unrealized fair value losses in excess of 50 million euros in a jurisdiction, then these should be excluded for the purpose of a safe harbor computation from the PBT. PPAs are highly relevant if you've got a highly acquisitive group. And the starting point is that if the QFS used to prepare CBC report includes PPA adjustments, then they will not be QFS unless they'll not be QFS unless certain conditions are met and adjustments are made. The first step is to identify how PPAs are being affected. Are they simply consolidation adjustments, which is what they typically are and are only reflected in your consolidated financial statements? If that is the case, then there is nothing to do. However, if they are being pushed down to the acquiring entity or the target entity, which is allowed under some accounting standards, then there will be some adjustments required. And this is something that is allowed under certain accounting standards. So if they are being pushed down into the QFS that are being used to prepare a CBC report, then there will only be QFS if the consistency condition is met, which is if the CBC report historically included PPAs, then the group should continue to include them for any reports that it files for any years beginning post 31st December 22. And if there is any goodwill impairment in relation to any acquisitions that were made post 30th of November 21, then these should be added back to the PBT for the purpose of routine profits testing and the simplified ETR. Another final adjustment that needs to be made for simplified ETR test is that a corresponding deferred tax adjustment in respect of the goodwill impairment will need to be made to the income tax expense if this has not been included. So you can see there's a fair bit of technicality around the PPAs. Another aspect of PPAs is that it is a practical challenge as well to firstly even understand how these are being recorded, as they are typically group level adjustments. So it does require interaction with a wider group finance team. We'll now move on to the arbitrage arrangements, which is one of the most trickiest of the adjustments and the one that we find is rarely picked by groups. So if we move on to the next slide, please. Arbitrage arrangements. So what is the purpose of these rules? They were introduced by the OECD when it found out that businesses were using the simplicity of the data for safe harbors as a road to abuse the rules, which was mainly arising due to the difference between the financial accounting and the tax treatment. There are certain guardrails in the full globe rules to deal with such differences, but there is nothing equivalent in the safe harbor rules, and hence the introduction of these rules. However, what we found is that these rules implemented for safe harbors are much widely drafted than the ones in the globe rules, and we'll see that in an example that I'll go through shortly. So where do these rules apply? These rules apply to arrangements that result in a deduction and non-inclusion outcome. So this is where the arrangement involves provision of a credit or making of investment between two members within a group, such that there is a deduction for expense in one member, but there is no corresponding income in the other member. It can arise where arrangements give rise to a duplicate loss arrangement, or where you have a duplicate tax recognition arrangement. So where 1 and 2 applies, there will be an adjustment needed to exclude the expense in the entity that's claiming it. And in respect of 3, you would have to exclude the income tax expense. In the absence of these adjustments, a safe harbor cannot be claimed. So you can see that it's important to identify whether the group does have any arrangements that will require such adjustments. It is applicable to arrangements entered into post 15th of December 2022 or 18th of December 23 if a jurisdiction is unable to enact laws retrospectively. And it can catch pre-existing arrangements if changes are made to such arrangements, such as changes to the terms of the arrangement or changes in accounting treatment. So I've got a little example here of a deduction and inclusion arrangement. And the reason I've picked this example is because this is the one we see most commonly in groups. And in this example, what we have got is we've got 2 entities within a group. Entity 1 lends money to entity 2, and then entity 2 claims a deduction for the interest expense. But entity 1 has brought forward tax losses against which the interest income is being offset, so it does not have a taxable income. Now, this arrangement will be potentially caught under the rules if there is no income or gain in the financial accounts of entity 1, which is not the case here. But it will also be caught if it is unreasonable to expect that there will be no increase in taxable income of entity 1 over the life of the arrangement. The way the rules have been written is that it will deem that there is no increase in taxable income if the interest income is being offset by brought forward losses or reactivating a locked interest capacity that arises from interest limitation rules. There is a distinction in the rules between whether the income is being offset by losses that have been recognized for deferred tax or not recognized for deferred tax. So to the extent that the interest income is being offset by losses that have been fully recognized for deferred tax asset purposes, there may potentially be no adjustment required, not required in the entity 1. So this is a very, very common scenario, and we see it often where groups have cash pooling arrangements or with treasury companies. Another point on this is that, as I mentioned, there is an equivalent rule under the GLOBE rules to deal with such scenarios. But under the GLOBE rules, the rules will only apply if entity 1 is located in a high tax jurisdiction and entity 2 in a low tax jurisdiction. But there is no equivalent provision under the safe harbors. So perfectly vanilla transactions can be caught by these rules. Another point on this is that OECD refers to this as hybrid arbitrage rules, but you can see clearly from this example that there is no hybridity required for these rules to apply. So if you move on to the next slide, please. So on this slide, so the second point I wanted to draw was that safe harbors and GLOBE calculations can give you different outcomes, and we've just talked about a classic example in this previous slide. But there are other areas which can give you different outcomes, and it is not necessary that a CBC safe harbor will always give you a more favorable outcome. So some of the common areas where the rules differ is in terms of calculating the taxes for the effective tax rate. So for GLOBE rules, the deferred tax calculation and withholding taxes and CFC taxes are much more complex, whereby the withholding tax and CFCs are allocated to the payer or the CFC entity. But under the CBC rules, they just follow the accounts. Another area where you could have a different outcome is in transactions. So, for example, when you have intra-group transactions, and depending on whether these are transferred across at net book value or market value, and how they're treated for domestic tax purposes, can either deliver a favorable or an adverse outcome for CBC. But there is an element in the GLOBE rules to neutralize the impact of such differences. Another difference is around elections. So like I said, the Globe rules have the opportunity to make elections for an alternative treatment, but there's no such elections under the CBC Safe Harbour rules. The third point, which my colleague Frederick has already mentioned, is around once out, always out rule. But the implication of this rule is that in-scope group will need to make elections for jurisdictions that have not currently enacted Pillar 2 rules in order to protect its right to make an election in future years in the transitional period. This is particularly relevant given UK is implementing the UTPR from 1st of January 2025, and so can bring jurisdictions that have not enacted Pillar 2 rules into the scope of Pillar 2 rules. And finally, there are implications to making a safe harbour election. One of the main ones is the transitional year rules. The main implication of this rule is that the group will have to track the carrying values of the assets that it has transferred in the period where they were relying on safe harbours, because it will have to track the carrying values, because a transferee entity will have to use the carrying value in the transferor entity in the first period when it comes into the scope of full Globe rules for its deferred tax calculations. So before I hand over to my colleague, Frederick, to dive into the specific Dutch tax provisions, I just wanted to leave with a few key points, saying that, as you can see, a qualifying CBC report is more than producing just a set of QFS. There are multiple elements to this process. Timing is critical to this process. So the earlier you start the process, the better you'll have time to fix issues. Fixing the issues will involve consideration outside of local tax team. It requires wider stakeholder input and discussions with wider finance teams. And remediating them will not be easy either. So with that, I will hand over to Frederick.
Thank you very much, Ato. And a last word on, so clearly this safe harbor, let's say, analyzing the eligibility for the safe harbors and having a very robust framework around this is not only you do something centrally and to satisfy your auditor centrally, let's say in the UPE jurisdiction, but in every jurisdiction where your group will be based, there may be someone who has a clear interest in understanding the calculations there, because they will have a material effect in some of the other jurisdictions. I have an example here where you could be a UK group that has centrally prepared safe harbor calculations. You're filing a GEAR in the UK, you've done your work, but the Dutch tax authorities could look at those numbers and at those calculations and may identify certain things that they think are worth clarifying from your side, because they could have a material effect on the outcomes, for instance, for the Netherlands. So there's a very clear rule we have in our Dutch Minimum Tax Act law, which says in this case, the Dutch tax inspector may questions, he may point you to certain facts and circumstances which could have a material impact on your calculation. And then it's up to you to demonstrate that these facts and circumstances do not have that effect. And you need to be prepared to answer that, because otherwise the Dutch tax inspector in this particular case may reject your safe harbor application for the Netherlands. It's not even bound to prove any undertaxation in the Netherlands. And I think this reaffirms again the point of having a very robust, solid framework to come to your safe harbor calculations. Having said this, I'd like to pass the microphone and camera to my colleague Ian Bowden.
Perfect. Thanks, Frederick and Hettel. I really appreciate the session. So my name is Ian Bowden. I'm a tax partner at BDO, and I look after our tax automation and innovation practice. And I focus on how technology is able to help you. Today, I guess, I'm going to talk a little bit around data. And luckily for me, the teams have already mentioned data repeatedly in all of their earlier slides. So it should be a very easy session. It is always about the data. Finding the data, getting access to the data, confirming that the data reconciles, as we've heard from Hettel a minute ago, and confirming it is actually the right data that we're pulling in is incredibly important. The irony, especially coming from an advisor who offers outsourcing services, the calculation part is a bit more straightforward, although that doesn't take into consideration the fact that there's a couple of country nuances to deal with here, as we've already heard. Nat, could you put me on the first slide, please? The data point for me is probably the reason why businesses are considering the how. And that's ultimately what is the right operating model for you and your business in relation to how you deal with this. What I've got on the screen at the moment is 3 main how categories, and appreciate there are subcategories under each heading. And when we start getting into the nuances of managed services, etc., but I've bundled them all into the 3 main groups. Broadly speaking, you can do it yourself, you can outsource it, and the category in the middle is the hybrid of those. For those that perhaps need a little extra assurance with a little a, without necessarily the full cost of outsourcing. Can someone really just double check your homework and possibly help you file it if needed? And that's our co-sourcing box. Now, I think I want to be clear, all 3 are really good options, and it will depend on your specific circumstances to determine which is the right approach for you. I will say there has been more interest in the 2 boxes on the left. And I think partly the reason for that is back to my opening statement. Look, it's all about the data. And with 200, 300 new data points to collect, there is work only you can do. Outsourcing everything, even to me, still means you need to get me the right data. And usually the best people to make a start on that data aren't an outsourcing firm. So your business needs to put in place a process to gather and validate that data. Whilst I can help initially with data readiness, impact assessments, all of those types of things, ultimately you need to be happy with the process and it needs to be repeatable. The other thing here is the Pillar 2 won't just be a one-off. You may want to do some planning, some forecasting, interim reporting. And that means you could be running the calculations many times a year with different data, using forecasting data, actual data, different scenarios. If your business deals in M&A activities, you might need to plan for the impact of those mergers and acquisitions. Outsourcing's great. It's always been great, but you could incur additional costs if you need me to run the calculations multiple times. So just to close out on this slide, operating model, insourcing, co-sourcing is an option. For it to be a valid option, though, there needs to be some good calculators available. And I have to say the market has really responded well. BDO, for example, is an approved implementation partner for over 15 software vendors who've launched solutions. We'll touch on those in a little bit more detail at the end. But what I can say on operating model, very few organizations are brave enough to build their own end product calculators. I wouldn't suggest it. The local nuances make buying the lower risk choice. I understand completely getting a check of those numbers, and that's where the co-sourcing has been a helpful and perhaps cheaper option. But you need to look now at how you're going to do your operating model. If you can pop me onto the next slide, please, Natalie. So quickly back to the data. And things to consider. This is a bit of a recap and an introduction into a little bit more data detail here. I've put this slide into 3 categories. The biggest is the data management section, then the calculations themselves, and finally the local compliance aspect. You're going to hear from Jason in a moment, who's going to claim that it's all about the process and the governance. And whilst he isn't right very often, he does have a point on this, and he'll spend a bit more time on the governance and controls points that you do need to consider. But we've heard already that the process is important. Gathering the data points is one thing, but tax won't own these data points. We are recipients of data, and data is going to move and change. I've written on the left-hand box on the slide about stakeholders. And that's the part that's often neglected. We're easy to talk about some of these other aspects, but there's a bit of an internal communication and a bit of a sales job here. Documenting the process and ensuring the key stakeholders, those that actually own the data, know why and when you will need the data. And I do like to see controls here at a systems level, if possible, to tell me in tax when something's changed. Please don't forget about the people aspect, and perhaps use this as an opportunity to get closer to finance, sometimes sharing your process diagrams, communicating your deadlines. It can help them feel part of your process and you part of theirs. As part of that, if you're doing any wider finance transformations in the organization at the moment, this is a great opportunity to include some of the new data points into your accounting systems or your consolidation systems. And that's going to help reduce the level of manual data entry that you're going to have to plug into your calculators. Asking the finance team if they are changing systems is a really good option, because sometimes they can pay for some of the systems that are there. If they're planning any changes, it's a great opportunity to add these new tax requirements in. And the Pillar 2 data points that you're going to see in a minute is that perfect starting point, almost a to-do list. Calculations, as we talked about, can be complex. Please don't build your own. Most of you won't have the resources locally to validate the calcs, maintain the calcs. I'm sure one or two of you on this call have inherited spreadsheets when you started new jobs, probably written by Dave, who left the firm 6 months ago. He may have taken the password with him. Lower your risk and consider how best to deliver this. Local filings is interesting. Some tools do offer the IXBRL conversion and tagging, or have made commitments along those lines. Others aren't there yet. But your impact assessment will give you a starting point for QDMTTs and the Globe return. With Safe Harbours, as we've heard, being a soft landing, and the OECD confirming that there's going to be no permanent Safe Harbours using CBCR data, this is going to be part of your long-term work with some luck. And there were some conversations recently that Ross was part of about Pillar 2 and whether it's going to replace compliance in certain countries, which could transform your outsourcing approach. But now, if you just pop me onto the next slide, please. Back to data again, if you don't mind. Appreciate this a little hard to see. Hopefully when the slides are shared, you can get a little bit more detail on this. But I just wanted to touch on this point. Our teams have done over 100 projects in the UK alone, looking at Pillar 2, and there is a big data exercise. Even if you're outsourcing it, or even if you're looking at impact assessment or full calculations. When I started doing this, I thought I would be able to grab everything from systems that you guys have got around the place, but that hasn't been the case. The best clients and the systems that we've come across have been able to grab about 60% of the data directly. The worst, sometimes it's been as low as 10%. Just flip onto the next slide for me now. The list that we've gone through, you'll see on the screen, you'll hopefully recognize some of the headings that are there. We've gone through an exercise to reduce the number of data points that you need from the 200-300 to the ones that we believe are material. There's some pretty color coding on here. Green for me is most people have, this is the standard stuff. Amber, I would love you to be able to get it, and I'd like to be able to automate it. So let's ask finance next time if I can actually include this in their systems and be able to pull it through. And red hasn't been great in a lot of examples. The worst example is around covered taxes, where there's been 20 plus reds. But there's still work there in terms of opportunities to where you source the data and how you can bring that in, but it does take time. Lists like these are really helpful and essential, and they can form the basis for new and updated changes. So just to close out my piece before I hand over to Jason, if we just pop onto the last slide for me, Natalie. Looking at the systems and what options that we've got. I think the key point here is to not look at systems in a vacuum. This is a fantastic opportunity to look holistically about what you're doing, what's coming down the line, the interactions between the provision process, the statutory financial statements process, your return process. Is there systems available that can potentially help? And I mentioned there's lots and lots of systems out there. I've popped 3 on screen here, and this isn't an exhaustive list, but they broadly form into 3 categories. On the left-hand side is the existing consolidation systems. So if you're running an Oracle or an SAP or a OneStream or a Tagetic, these guys have brought out some great options where your data is going to be already in one place, and they've been able to introduce some tax calculators as part of the process. When I look at the box in the middle, again, it's back to that holistic point of what do you do at the moment and how do you interact with these things. Some of the tax compliance vendors have produced some solutions that add on to that. So existing provision tools, existing compliance tools. And again, Walters Kluwer's got another solution in this area. And for those in the UK will recognize the names of Alpha Tax and Thomson Reuters in terms of the return software that they use. But there's some really good options in terms of if you are using existing systems to be able to move data between them. Longview's connectivity between the provision tool and the Pillar 2 is there. And then on the far right-hand side, there's been some new entrants, perhaps a couple of names that you haven't heard of to the market. Thomson Reuters has created a great joint venture with Orbitax to be able to make some very big and some very interesting commitments in terms of what they're going to offer. But then some new starters, some smaller names you might not have heard of. ARC's an excellent example of a really well-managed UK company who had a consolidation system and then was able to add in some tax calculators for various bits and pieces. And again, it's worth looking at the market. There's some fabulous options out there if you're thinking about insourcing or you're thinking about co-sourcing that side of things, because you own your own data. Being able to move that data into one of these tools and think about the wider implications for you as a business, it's easy as an advisor for us then to come in and validate and check your homework when it's in an existing tool. We'll have comfort, at least the calculations right, and we are able to look at those areas in that particular example. But that's it from me in terms of data. Appreciate it's a bit of a whistle-stop tour today, but I'll hand over to Jason and he's going to talk to us all about the governance and controls, and apparently it's all about governance. Jason.
Thanks, Ian. Really appreciate that. Hi, everyone. So I'm Jason Land, and my focus is on tax operating models, tax governance, controls, and technology. Well, I think that governance really has been well covered already on this session. Well, no, not using the specific governance term. I think it's pretty much everyone has talked about the importance of process and controls that are needed. And Ian just talked about the data. And to be fair, data is critical. But I think it's clear that even Ian acknowledged, and he rarely acknowledges anything I say, but I think he even agrees that it's actually about what you do with that data rather than just the data itself. You know, there's elements around how that data is managed, how it's processed, how it's controlled, and then how it's reported either in your financial statements or to relevant tax authorities. And so there's clearly a need for good, thought out strategies on this, strong evidence-based controls and systemization wherever possible. And implementing good tech over bad data or uncontrolled processes will only lead to bad processes enabled by tech, or as Scott said, garbage out, right? And that's why governance supporting that detailed underlying processing is so important. So we'll move on to the next slide, which I see has already arrived. So thank you for that. This is Ian's slide essentially, but it's broken up into these three sections: data management, reporting, and compliance, right? So you need the availability of data. You need to surface those right data points, and you need to extract and process them in a controlled manner using some kind of system or data. As Ian said, it's best not to try and do that in-house through that Excel worksheet if you can avoid it. Because what you need to be able to do is drive a control and evidence-based calculation. And Scott and Frederick and Hetal talked a lot about what that's required from a process perspective. But actually, you need to wrap that in governance. You need to wrap the controls around that so that by the time that you get to those underlying tax disclosures and returns, then you're in a position to be able to evidence of what you've done and the basis for it and the impact upon it. And actually, there's good management information you'll be looking for that's going to influence all sorts of things. So there's these key dates coming up, right? So year end in 2023, the statement of that impact of Pillar 2, if it's material, probably looked at by auditors, right? 24 and 25, the calculations within the financial statements of that current tax impact. And then going into 2026, there's going to be the submission of those returns to relevant tax authorities. Now, it will have an impact for businesses, and it may drive that planning piece, as I said. It will definitely be audited, and it will definitely be reviewed by tax authorities. And actually, in the UK, we're seeing this kind of renewed focus on this expectation of controls and embedded risk management across all the taxes, right? And I think Pillar 2 is just going to be another part of that. And we're seeing that more recently in the UK. The HMRC have published about 10 different documents that are guidelines for compliance in different areas, that drive the control, the governance piece. So this is complicated. We've spent an hour and 6 minutes talking about the data points and what you need to do with that, and having the controls around it is kind of key. And HMRC, they go through a business risk review process in the UK, and they're asking significantly more questions around the existence of risk and control matrices, being evidence. What are your controls? What are your key controls? What evidence that they're operating effectively do you have? And it may be a point when you're publishing your next tax strategy as to what the impact of Pillar 2, what you've done, etc. Next slide, please. So what you need to have is this defined and documented processing controls around what you are doing to satisfy your auditors, essentially. And that might be risk and control matrices. That might be a set of races, essentially a matrix of who's responsible, accountable, consulted, and informed. You'll need evidence that those controls have operated effectively and assurance over that data. And you need to be able to flex what you have in place and monitoring and review once this is in place, because there are developing requirements. I think Ian told me last week that there were 15 changes on QDMTT that had been published recently. And it's not just internal changes, right, or external changes. There's internal changes to what you do as a business as well. Businesses are always changing, adapting, moving, changing the way they do things, and all of that needs to be built into your ongoing governance model to support your Pillar 2 compliance and reporting. So it's important that you standardize wherever possible, look for efficiencies, use technology to the right level, and make sure you can take out that lags and inefficiencies in the processes. Pillar 2 is kind of a big deal, and boards are really interested in it. And tax teams, well, if you're sitting in industry, you may feel a little bit siloed. That's probably why you're here, right? To hear what people who deal with this every day do. But it's difficult because tax often operate in these silos, and they operate often on a best endeavours spreadsheet basis. And actually moving away from that is going to be key, because this is a big ticket item and it needs to be addressed appropriately. The auditors, you might be within SOX, you may be looking forward at the new UK corporate governance rules that are coming in. There's a conflict with how much you can share with these people, how much you want to share. So preparing the enough evidence to support what you are doing, but kind of not oversharing too much, and ensuring that you can satisfy those questions, that you've validated that data and that accuracy. And there may be internal conflicts as well. I think Scott talked about the different teams being responsible for different data points. And then we have seen some issues where there are conflicts, where people didn't want to share data internally. And that's something that needs to be smooth. So walking through how does this need to fit together, and how do we make sure that the processes work and come together effectively and the controls operate as you need, is important. And the tax authorities, as I said, I've already said that tax authorities are really interested in this stuff. But actually in the UK, we have something called the Senior Accounting Officer legislation for large corporates. And that requires a certain senior individual to submit something to HMRC annually to certify whether or not they had appropriate tax accounting arrangements. HMRC initially said that Senior Accounting Officer, Pillar 2 wasn't within it. And then they changed their mind and said, well, actually, it is in it. And then they said, well, it's not in it. And now we're kind of in this limbo where it's not quite clear. So the underlying message is, it is important. It does need to be controlled, and having evidence-based controls, risk and control matrices, governance to support that is going to be really important. Next slide, please. Final slide, in fact. So I just thought it was useful to set out a process for the way that this needs to work in practice. And the overarching message here is you need a systemized, structured way of dealing with it. Ad hoc, working your way through it piece by piece and seeing where you get to is not the answer. It's the same process as you'd need to build your technology strategy or the way you implement your technology, but every step needs the right governance and controls to be thought about to ensure that the numbers are as right as possible and you're able to evidence this to third parties. And that monitoring and review piece, responding to change, whether it's internal or external. Scott talked about the processes and approach that he has, and it will be crucial to think through. And that's kind of something that needs to be embedded going forward. So in summary, it's about the technical, it's about the data, but it's also about the processes, the people, the governance, the controls that support the way that you deliver on this. Thanks very much. I think it's back to Ross.
Great. Well, that was a full agenda. We've still got nearly 400 of you with us. So thank you to those brave souls who have stuck it out and stayed with us throughout. I mean, even with all of that content, we're still only really scratching the surface of what is a huge topic. But maybe just to help bring some of it together that I've spoken or that we've spoken about today, I'll just offer some of my takeaways. So I think with 64 territories having either enacted or being in the process of enacting Pillar 2 legislation, there will be very few large multinational groups that are not impacted in some way. The rules are complex, but breaking them down into methodical process is possible and indeed critical. And that methodical process will set the foundation for effective compliance and reporting processes, including the potential for data automation and establishing the right governance, as Jason spoke about. Safe Harbours may help to simplify the overall process, but their application should not be assumed. As Frederick and Hettel covered, there's many challenges in the application of the TCSH in particular. And in the absence of precedent and in many cases clear guidance, in my view, a prudent approach should be adopted. And if you have not yet undertaken a comprehensive review of your CBCR process and you intend to rely on the TCSH, then now is the time to do so. In applying the safe harbours, be wary of the challenges we discussed in particular around hybrid arbitrage arrangements. As mentioned, despite the name, there is no requirement for hybridity within those arrangements, and there is no tax motive requirement. So arrangements that are entirely commercial and not manufactured for tax in any way can be affected. And also there are many ordinary course transactions that could disqualify you from application of a safe harbour in a jurisdiction. The key transactions to watch out for will be those where there is book income but no corresponding tax charge. So identifying those challenge areas early and thinking about carefully how you might structure them will be really important. For example, what value should you affect an internal asset transfer at, if at all? You may not have historically cared because it was tax neutral. Now it matters. With UTPR coming, think about how that might impact your group if your UPE is in a territory that has not implemented the IIR. Might there be benefit, for example, in inserting a holding entity that has implemented IIR to help you manage the compliance burden, so you're dealing with an IIR calculation rather than a multitude of UTPR calculations? If not, are you just running not just running one Pillar 2 calculation, but you could be running multiple Pillar 2 calculations on a single jurisdiction under multiple different UTPR legislative frameworks, which could add significant compliance and reporting complexity. When thinking about how you manage your data, I think a key first question will be how you want to manage Pillar 2 as an organization. Will you insource, co-source, or outsource? There's no one-size-fits-all answer to that, and the right approach for your group is likely to depend upon a combination of both your resource capability and appetite to take on responsibility for these complex rules. Given jurisdictional variation, it's likely that you will need external support in some or all territories to help with that jurisdictional nuance and last mile filing as a minimum. And now is really the time to think about how you will organize yourself and create that governance structure, as Jason was talking about, if you've not already done so. There are a number of technology solutions available on the market, as Ian mentioned, that can support your compliance and reporting processes. Selecting the right fit for your organizational needs will be really important. And then establishing effective processes around how you manage the data going into that to get the most out, as Scott was talking about, will be critical. You not only need to get to the right answer, but you also need to be able to give confidence to stakeholders that you've got to the right answer. So having that methodical, systemized process for Pillar 2 that you've got well documented, and then wrapping effective governance around that will be critical to achieving the overall end goal. So if you could just flip us on, Nat, to the further resources. Just one more slide, please. No, another one again. And again, further resources. There are further resources available to support you on your journey, including our new Pillar 2 Pulse newsletter, which we launched yesterday, which we'll use to keep you updated on key developments and provide general guidance on navigating the rules. Please do just subscribe through the link in the slide pack or search for BDO Pillar 2 Pulse directly on LinkedIn through my profile. We'll be running another webinar in February on the Pillar 2 impact on business as usual, including structuring and M&A, where we'll get into the Pillar 2 treatment of common transactions, including some bear traps to watch out for. So please do join us for that. And otherwise, just please feel free to get in touch for a chat. We would be delighted to help. So with that, we've run to time. Thank you again, everyone, for joining us, and we hope to speak to you, or if not, see you again soon. Bye-bye.